While various authors and books have attempted to delve deeper into the reasons why Latin America is still largely poor and has failed to reach the level of development of the United States and Canada, it is evident that there are multiple causes, and these have influenced the low level of development of Latin American countries in different ways. In this video, we will review some theories that explain the tremendous differences in development and income between North and South America, as well as a historical account of the economic evolution and development of both parts of the Americas. When looking at current per capita income figures, the differences are abysmal, with the United States averaging nearly $85,000 per year and Canada averaging $53,000 per year. In Latin America, the average per capita income, or GDP per capita, is only $11,000 on average, with Panama at $19,000, Costa Rica at $17,800, and Chile at $16,300 being the countries with the highest average per capita incomes. If the figures are adjusted for purchasing power parity or GDP per capita PPP, the ratio is slightly less exaggerated, but still shows incomes more than double for those in the North compared to Latin American countries. In GDP per capita PPP, the United States averages $75,000 per year and Canada $56,000, while the Latin American average is $20,000. The best indicators in Latin America for GDP per capita PPP are Panama at $44,000, Chile at $35,000, and Costa Rica at $31,000. Traditional explanations of the causes of the differences in economic development between Latin America and the United States and Canada have highlighted factors such as differences in the security of property rights, levels of corruption, financial sector structures, investment in public infrastructure and social capital, and even propensity for hard work or entrepreneurship. But some authors have attempted to delve even deeper into the causes, seeking to understand the genesis of these differences. Douglass North, Nobel Prize winner in economics in 1993, asserts that North America was colonized by British settlers, who from the outset had a strong culture and structures favoring private property rights. Years later, during waves of migration from Europe to the Americas, some settlers also brought knowledge related to the first industrial revolution that was booming in Great Britain. Additionally, North believes that because the English did not consider the North American colonies important for their development, they accepted that these territories should have greater autonomy and freedom in their governments, allowing for stronger institutions to be consolidated in the United States from the outset. This autonomy also allowed for greater economic and political freedom, which allowed for more opportunities for business creation, which, combined with access to large amounts of natural resources, boosted economic and business growth in the North. In contrast, according to North, Latin America was colonized by the Spanish and Portuguese, whose vision was primarily to exploit mineral resources such as gold and silver. The institutional structure established in Latin America was monopolized by Madrid and Lisbon. Although after independence, Latin American countries tried to establish their own autonomous institutions, it seems that the lack of a legacy of free government led to half a century of civil wars, attempting to fill the gap left by the Spanish and Portuguese governments. This led to the fact that after independence from Spain and Portugal, according to Victor Bulmer Thomas, the living standards of most countries barely improved, stagnated, or even declined, as average economic growth in Latin America between 1820 and 1870 was only 0.2% per year. Exceptions during this period were Chile and Costa Rica, which achieved some level of political stability and acceptable growth close to 1% per year. During that same period, the United States was already achieving average annual growth of close to 1.5%, very similar to that of European countries. Canada, while only averaging 1%, enjoyed much better economic growth than Mexico, Peru, Colombia, or Central America, which all had growth rates close to zero. Over the next 50 years, things improved somewhat, and between 1870 and 1920, Latin America achieved average annual growth of 1.6%, thanks to increased exports of raw materials, and in some countries to greater political and economic stability. During this period, there are positive exceptions, such as Argentina, which achieved average annual growth of 2.5%, well above countries like Colombia, which grew at 1.2%, Peru, which grew at 0.9%, and Mexico, which reached 1.3% annually. Another success story was Chile, which managed to grow at 1.8% annually. During the same period, the United States grew at an average of 1.8% annually, and Canada accelerated its development, growing at 2%. But what's important here, besides the figures, is understanding the causes of this disparate growth. During this period, the United States and later Canada saw the development of the so-called Second Industrial Revolution. Large industries and companies developed in the steel, petroleum, electricity, chemical products, machinery, and auto production sectors, leading to the creation of some of the most important companies in the world at the time, such as Ford, General Motors, Standard Oil, which later split into ExxonMobil, Chevron, and BP, General Electric, Procter & Gamble, and J.P. Morgan, to name a few of the companies created during that time in the United States. And in the case of Canada, companies such as the Canadian Pacific Railway, Imperial Oil, and Hudson's Bay Company were created. During that same period, the United States welcomed millions of immigrants, allowing its population to increase from 40 million in 1870 to more than 100 million in 1920. This allowed for an abundant working-age labor force and increased domestic demand for goods and services, which boosted industrial and agriculture development. During those years, the United States also achieved integration through the construction of the world's largest railway network, which grew from 85,000 kilometers in 1870 to more than 400,000 kilometers in 1916. Having this railway network opened new markets for trade and provided a cheap means of transportation for transporting goods to ports for export. North American companies managed to consolidate themselves as true industrial empires, positioning themselves as multinationals that generated large profits and provided quality employment. During that same period, industrial growth in Latin America was quite incipient, and countries focused more on the export of raw materials, such as wheat, coffee, copper, meat, bananas, and sugar. Some countries, such as Argentina, Chile, and Uruguay, received millions of migrants who helped improve agricultural productivity and develop some modern industries. During that period, both the United States and Canada managed to consolidate their political and financial stability, offering businesses and investors high legal security and solid financial systems. This allowed both countries to receive large amounts of foreign investment, helping companies finance their growth without relying solely on credit. During that period, the United States and Canada also managed to consolidate strong political stability. By the 20th century, there were no major internal conflicts in the Northern Territories. While some Latin American countries still faced numerous internal and external conflicts, most notably the Thousand Days War in Colombia and the Acre Revolution, in which Bolivia was forced to cede more than 300,000 square kilometers to Brazil, the Mexican Revolution occurred during this period, along with multiple civil wars in Central America, the Chaco War in Paraguay, and the consolidation of various military dictatorships in countries such as Argentina, Brazil, Cuba, and Central America. These conflicts were also part of the Latin American political landscape, as were successive coups d'etat in different countries. During the 1930s, 1940s, and 1950s, internal and external conflicts continued in Latin America, such as the Leticia War between Colombia and Peru between 1932 and 1933, the Bogota Apocalypse in Colombia, and the conflict between Ecuador and Peru in 1941. Although the United States played a significant role in both the First and Second World Wars, it can be considered to have benefited somewhat from these military conflicts. It became the primary supplier of food, weapons, and credit to the Allies, eventually establishing itself as the world's leading power. In fact, during the First World War, banks like J.P. Morgan lent billions of dollars to France and England, earning significant profits from the interest on the loans. Additionally, unemployment decreased as the United States became the primary supplier of weapons and food, where large numbers of workers were needed. And in the case of World War II, massive military spending allowed the United States to reduce its unemployment rate from 14% in 1940 to less than 2% in 1943 thanks to all the military production deployed, where thousands of airplanes, ships, tanks, and munitions were manufactured. In fact, it was one of the periods of the best growth in North America, allowing a 75% increase in GDP between 1940 and 1945. The military industry enabled great advances in the fields of electronics, aeronautics, chemistry, and medicine, which were subsequently exploited by industry. Additionally, unlike Europe, the Americans did not suffer major material and infrastructure damage. Furthermore, because the United States was in better shape than Europe, it came to control 2/3 of the world's gold reserves. As if that were not enough, the dollar consolidated its position as the world's reserve currency. In fact, in the 1940s, the United States achieved extraordinary annual growth, averaging 6%, one of the best in the world. On the other hand, while Latin America also achieved good growth, it was closer to 4%, with the exception of Mexico, which also achieved 6% annually thanks to being a major supplier of raw materials to the United States, such as food and oil for the military industry. Among the companies and industries that grew in the United States after World War II, taking advantage of the development of patents and infrastructure, was Boeing, which shifted from manufacturing bombers to commercial airplanes. Companies such as IBM, Motorola, and Texas Instruments used wartime developments, such as radar, radio, and primitive computing, to develop the first computers, communications equipment, and the early semiconductor industries. The first computers, such as the ENIAC and Colossus, were designed based on ballistic calculations. Other companies that benefited after the war were those in the automotive sector, such as Ford, General Motors, and Chrysler, which shifted from manufacturing tanks and jeeps to making cars, SUVs, and trucks for work in the countryside and cities. Another sector that benefited was the petrochemical and plastics industries, where wartime research into new materials, explosives, and fertilizers was used by companies like DuPont. The pharmaceutical industry also benefited from advances in vaccine and penicillin production, with companies like Pfizer, Merck, and Eli Lilly growing thanks to the mass production of antibiotics. During the 1960s and 1970s, Latin America achieved very strong economic growth, exceeding 5% over the 2 decades, with success stories such as Brazil and Mexico, which achieved growth rates even exceeding 6%. In Brazil's case, an import substitution model was consolidating an industrialization process in the automotive, steel, cement, and petrochemical sectors, with a consolidation of companies such as Petrobras and Embraer, while also developing infrastructure such as roads, ports, and dams. A similar situation occurred in Mexico, where development was achieved in sectors such as the automotive, steel, textile, and chemical industries, in addition to oil exploration, which allowed for financing of various development projects. Both countries benefited from foreign investment and a degree of political stability. Countries such as Colombia, Venezuela, and Peru also enjoyed average growth rates above 4% in the 1960s and 1970s, thanks to high commodity prices and greater political stability. The sharp decline came in the 1980s, known as the lost decade, when average growth in Latin America was close to 1%. For some analysts, among the causes of stagnation was the Mexican debt crisis that engulfed the entire region. The cost of its debt skyrocketed due to increased risk, leading to rising inflation in Argentina, Peru, Bolivia, and Brazil. This forced governments to implement sharp fiscal cuts and cuts in public spending, leading to stagnant wages throughout the decade. In the 1990s, things improved slightly in Latin America, achieving average growth above 3%, with success stories such as Chile, which consolidated its position as one of the most stable economies in the region, achieving average growth above 6% annually. Unlike Latin America, the United States and Canada did achieve growth above 3% in both the 1980s and 1990s, driven by the so-called technological revolution that has fueled growth in recent years. Where the development of microprocessors accelerated, with the rise of companies like Intel, AMD, and Motorola, which managed to mass-produce computer equipment. Companies like IBM, Compaq, and Hewlett-Packard manufactured millions of personal computers, and Microsoft developed the software for these devices. The 1990s also saw the emergence of so-called dot-com companies, such as Amazon, eBay, and Google, which changed the landscape of commerce and consumption worldwide. These companies led to a productivity boom that benefited almost all productive sectors and also encouraged investment in the technology sector. Over the past 20 years, economic growth in the United States has not been spectacular, but it has remained stable. Growth in the United States over the past 20 years is largely due to the rise of the so-called big technology companies like Microsoft, Apple, Amazon, Google, Meta, and NVIDIA, which have achieved enormous profits thanks to their growing sales worldwide. Americans also benefited from fracking, which allowed them to increase their oil and gas production, making the United States the world's leading crude oil producer and avoiding foreign energy dependence. In addition, starting in 2008, the United States weathered the 2020 health crisis, avoided economic recessions, and successfully implemented monetary stimulus after the 2008 crisis. This strengthened consumer investment and stock markets, which also benefited from low interest rates brought about by the Fed's sound monetary policy management. Canada also benefited from exports of oil, gas, and other minerals, such as copper, nickel, and gold. It also enjoys solid financial stability and an appropriate immigration policy to attract human talent from other countries, while Latin America, on the other hand, has experienced quite uneven growth in recent years. While countries like Panama, Peru, and Colombia achieved average growth of over 3%, others like Argentina and Venezuela have even seen negative annual growth. In the case of Argentina, the average annual growth was less than 0.5% due to high inflation, capital controls that slowed investment, and high debt. Venezuela, for its part, has had one of the worst recent growth rates, averaging less than 8% annually, due to the collapse of the oil industry, which went from producing more than 3 million barrels per day in 1998 to 700,000 barrels in 2020. This led to phenomena such as hyperinflation, due to trade sanctions and financial isolation, which led a large portion of the productive population to leave the country, curbing domestic consumption and investment. Large economies such as Mexico and Brazil achieved growth rates close to 1.5%, which, while positive, has not allowed them to reach the income levels of developed countries. While the region, with the exception of Venezuela, has achieved greater economic and political stability, it has not yet taken the next step toward consolidating its position as a developed economy, possibly due to the fact that its educational systems are still quite far behind those of so-called developed countries in terms of quality, both in basic and higher education. This is in addition to the lack of investment and development in science and technology, as well as factors such as corruption and a lack of institutional stability in some countries. In another video, if you give us a like, we will review the more structural causes that have fostered the vast differences between the North and South of Latin America. Remember that in the video description, you'll find a link to the best course to learn technical and fundamental analysis for investing in stocks. There is also a link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you liked the video, give us a like, subscribe to the channel, and share the content.